Lesson 6 in Section 1, Evaluating Market Liquidity and Volatility. We will dive into the charts later in this lesson, but let's just quickly go over some points right now. Then we'll go take a look in the chart so you can actually see how to identify these areas. So liquidity is the degree to which an asset can be bought or sold quickly at a fair price. Now that is the technical definition, but I'll kind of explain this when we're in the charts of really it's where people are either wanting to take a trade or get out of their trades. That's the easiest way to look at it, and I'll show you in the charts. Volatility refers to the degree of price fluctuation in an asset over time. So at market open or around high impact news, which we'll cover later, you're going to see big candlesticks in the charts, and that's indicating that the volatility is increasing. So when trading the Forex and futures markets, it's crucial to know these areas and know what time price is likely to start spiking heavily and trade accordingly and have a good risk management system so you don't get caught in these bad situations. So let's go into the charts and I'll show you how to start identifying these areas. We're going to stay on the Bitcoin from earlier, and as you could see, remember we were looking for buys. We were way, I think, back here is when we were doing it. No. Yeah, back here. We were looking for buys back here. You could see Bitcoin did have a good spike, but we really, yeah, we did get hit into our entry right around here. Anyways, so liquidity. If we go back to here, you could see this. All that was liquidity that was really high right there. Price came up. People wanted to take a breakout possibly. Came back down. If they had a stop loss right here, guess what? Got taken out. That's the liquidity point. People thought it was going to break out. If they had a stop loss here, they would have been good, but if they did not take profits, see, this is why you need to take profits. If they did not take profits on this and thought it was going to go even higher, what did price do? Where their stop loss was, smacked them out, and now price is going back up. We could keep playing this over and over. It took out this liquidity, right? This is a swing. It took out that liquidity. If people said, okay, now we're going up, guess what? They got taken out. It went up. They thought it was going to break out again. Liquidity here. Boom. Got taken out. And you could flip the script. So maybe people thought once it broke through here, they're selling. Well, if they're selling here, they put their stop loss up here. Guess what? Taking them out. Coming down. Play it again. Stop loss there. If they did not take profits, guess what? They're out of their trades now. Here, took liquidity. Maybe people thought we were going down. Guess what? Stop loss is there. Taken out. Now the breakout people are in trades, right? So all these people are riding this wave. Price probably retraced, went back up, and they're like, okay, let's move our stop losses to here. They're out of the trades. They may have got profit, depending on where they bought, but now they're out of the trades. So if price does run up higher, they're out of their trades. They're going to have to re-enter. And that's how you identify liquidity. Now, these high volatility areas, this green box right here is London open. So usually at the beginning of London, it runs. And not sure what happened here, but price is usually going to keep running through London unless this was the reversal. Then we're going to pull back and drop lower and continue to the downside. And maybe we target anyone who has a stop loss down here or breakout traders trying to go in. And then once they're taken out, maybe we go back up. and back down. So the market is always going to be playing games with you. They're going to seek liquidity, hit it, go the opposite way, start getting those people in, go the opposite way. So they like to fake them out a few times. Think of it like basketball or hockey. When you deke them out, you move a couple times, try to make them go left and right, then left again. So now they're confused, and then you go the intended way that you're going to do. So, and the market's going to do that to you. It happens every time. Look, up, down, boom, went our way, back, up, down, our intended way. Up, down, up, our intended way. Up, down, our intended way. So in the advanced course and even towards the end of this, we'll start looking at ways you could find areas to help you out and understand where price is going. But just wanted you guys to quickly know what liquidity is, and these big spikes are volatility. And we're going to start learning in the later sections of this course how to identify these news events that create those crazy spikes.